Welcome to this explainer. Today, we're putting CVS Health's Q1 2026 data through the absolute ultimate investor's gauntlet. We aren't just skimming an earnings report here, we're acting as expert investment analysts, taking the stock and systematically stress testing it against the legendary frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, plus running some modern discounted cash flow models. Let's dive right in and see what the numbers actually reveal. Here is our roadmap for today. 1. CVS Health Company Snapshot. 2. The Warren Buffett lens. 3. The Peter Lynch lens. 4. The Benjamin Graham lens. 5. DCF and alternative valuations. And 6. Final synthesis and verdict. Section 1. CVS Health Company Snapshot. So CVS Health, trading under the ticker CVS, we're looking at a $115.6 billion market cap integrated healthcare powerhouse. You really got to remember, this isn't just your neighborhood corner pharmacy anymore. They've gone through a massive structural transformation. They've bolted together retail, pharmacy benefits management through Caremark, and actual health insurance through Aetna. And the sheer scale they've achieved is just wild. In Q1 2026, they smashed right through the $100 billion quarterly revenue ceiling, hitting $100.4 billion. That's up from $94.6 billion a year prior. Adjusted EPS also bounced back nicely, going from $2.25 to $2.57. That reflects a 6.2% top-line increase, which shows some really solid momentum even with all the industry headwinds out there. Right now, the stock is sitting at $104.33, offering an annual dividend of $2.66, which translates to a 2.55% dividend yield. It's actually been beating the S&P 500 recently, but that leaves us analysts with the million-dollar question. Is this an undervalued gem? Or is it totally priced in? To figure that out, we need our gurus. Section 2. The Warren Buffett lens. Okay, let's run CVS through the classic Buffett checklist. First up, the economic moat. Buffett absolutely loves a wide moat, and CVS definitely has a massive, scale-driven one thanks to its highly diversified defensive revenue streams across insurance and pharmacy. Second, earnings. They're consistent, and management actually just raised their full-year adjusted EPS guidance to a range of $7.30 to $7.50. Third is debt. Now, they are heavily levered from those huge acquisitions, but their cash flows make it manageable. And finally, management. They are under extreme pressure right now to prove all these different segments actually create synergy together. But to truly view this through Buffett's eyes, we have to calculate the intrinsic value based on what he calls owner earnings. That's the actual cash a business generates that can go straight to shareholders. Since our Q1 summary didn't break out exact capital expenditures, we're going to transparently use their operating cash flow as a proxy. And wow, they generated $4.2 billion in operating cash flow in Q1 alone, and they're guiding for at least $9.5 billion for the full year. So CVS easily passes Buffett's test for being a total cash-generating machine. But Buffett is famously strict about his margin of safety. At $104, he'd probably admire the business, but he'd definitely wait for a lower entry price. Section 3. The Peter Lynch lens. Let's see what the champion of growth at a reasonable price would say. Lynch famously put companies into specific buckets, and CVS fits perfectly as a stalwart. It's a massive, established $115 billion giant offering predictable growth and a reliable dividend that protects you during a recession. It's not a fast grower, and that's totally fine, but we just have to price it accordingly. This brings us to Lynch's holy grail, the PEG ratio. That's the PE multiple divided by the growth rate. Using the $7.40 midpoint of their new EPS guidance against the $104 price, we get a forward PE of about 14.1. Now, our source data doesn't give us a multi-year EPS growth average, so we're going to use that 6.2% revenue growth as our proxy. A PE of 14.1 divided by 6.2 gives us a PEG ratio of 2.27. Lynch strongly prefers a PEG closer to 1.0, so in Lynch's framework, this stock is a definitive hold. Section 4. The Benjamin Graham lens. Time for the strictest test of all. Let's run Graham's defensive investor checklist. Adequate size? Pass, easily clearing the multi-billion-dollar hurdle. Earning stability? Pass, they just raised guidance. Dividend record? Pass, with 4 consecutive years of growth. And they literally just returned $850 million to shareholders this quarter alone. Moderate PE? Yep, 14.1 is well under Graham's usual limit of 15. Qualitatively, CVS looks great. But Graham is a strict math guy at heart. To get his exact intrinsic value, we use his famous formula, the square root of 22.5 times EPS times book value per share. Here's the catch, though. Our Q1 documents completely omit the current book value per share. So to finish our math, we're going to make a clear assumption. We'll estimate a conservative book value of $60 per share. Plugging in our $7.40 EPS estimate and that $60 book value, Graham's formula spits out an intrinsic value of $99.94. With the stock currently at $104.33, there is absolutely zero margin of safety. For a strict Graham disciple, this makes CVS a wait or a sell. Section 5. DCF and Alternative Valuations. Let's step out of the history books for a second and run a modern DCF sensitivity matrix. We're using the company's own $9.5 billion cash flow guidance as our base. Assuming a standard 8% weighted average cost of capital, or WACC, and a 2% terminal growth rate to reflect its mature, stalwart status, our base case DCF lands right at a fair value of $103 per share. That is incredibly close to where it's trading today. And when we stack up alternative models, the alignment is frankly amazing. Our DCF sits at $103. The consensus Wall Street analyst target is $102.26. And if we run a dividend discount model, assuming a 5% dividend growth rate on their $2.66 payout, we get a slightly lower valuation of $88.66. Overall, everything is clustering incredibly tightly right around the low hundreds. Section 6. Final synthesis and verdict. We've run the gauntlet, and putting these frameworks side by side makes the picture crystal clear. Buffett loves the moat and cash flow but would hesitate on the price. Lynch says hold because the PEG ratio is above 2. Graham says wait, demanding a margin of safety below his $99 calculation. And both our DCF model and Wall Street say fair value is right around $102 to $103. At $104.33, CVS is priced almost exactly at its intrinsic fair value across multiple completely distinct financial models. So our final blended verdict on CVS Health, it's a definitive hold. It is a remarkably solid defensive stalwart. It prints massive cash and pays a really reliable 2.55% yield. But if you want to trigger a true Graham or Buffett-style deep value buy, you'd need to wait for a broader market pullback to drag the stock down into the low 90s. CVS's physical and digital footprint is just massive. And while their healthcare benefits segment is finally showing a sharp margin recovery, leadership is still under immense ongoing pressure to prove to Wall Street that bolting an insurance company, a pharmacy benefit manager, and a retail chain together will actually create real long-term synergy. So I'll leave you with this provocative question for your own portfolio. Does breaking the $100 billion quarterly revenue ceiling prove this integrated healthcare turnaround is finally complete? Or will rising medical costs and relentless regulatory pressures keep this stock grounded exactly where it is? Thanks for walking through the gauntlet with me today. Keep analyzing, and I'll catch you in the next explainer.